This is Bloomberg Surveillance Early Edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. BOJ shocker. Governor Kuroda stuns the markets by adjusting his yield curve control policy, signaling the central bank may be inching towards normalization. Well, traders jolted. The Bank of Japan's surprise sends the yen to its strongest level since August, while government bonds and global equities slump. I think also we have a bit of jolting right here, but criminal charges as well. A House committee recommends that Donald Trump should be prosecuted for his role in the January 6th assault on the U.S. Capitol, the first ever referral of a former president. Now let's check in on the markets. Now, Treasury yields rising, global equities are falling overall after the BOJ really emulated central bank peers, something that not a lot of people were expecting, with a hawkish move that really lifted the yen. I mean, some of the moves that we saw overnight are really quite incredible. Yen, the highest in more than 4 months. That sent domestic bond yields 20 basis points higher. Now, on the back of that, European stocks opened about 1% lower, and we're still seeing similar pressures across the board. The S&P 500 futures actually regaining some of the losses, now only down 0.1%. Of course, until now, the BOJ had been the outlier among central banks, no more, and then it depends on what the markets are pricing. So we were just saying the Bank of Japan shocking markets by doubling a cap on 10-year yields, sparking a jump in the yen and a slide in government bonds. The governor, Kuroda, says the move should not be seen as a rate hike. He was very clear on that. He does not think further widening of the yield band is also needed. Now, we're joined by Hugh Gimber, global market strategist at JP Morgan Asset Management, and our team leader for EMEA Equity Services, Ksenia Galuchko. So thank you both for joining us. I mean, who said this week was going to be boring, Hugh, right? It was like we're kind of like getting ready with our mulled wines and Christmas pudding, and then Kuroda gets in there and says, actually, not so much. Is this normalization, towards normalization? Or do you believe him when he says, look, this is not it, it's just a market functioning?
I think it's very difficult to see how the Bank of Japan's current policy is sustainable, because clearly the markets have been shocked by the moves overnight. I think that was inevitable given the nature of yield curve control. You can only ever end it with a surprise to avoid the market trying to break that limit for you. But now looking forward, you read the statement, inflation is transitory, wage growth is low, we think this will wash out. I kind of think, well, where have we heard this before? It feels very difficult for the Bank of Japan to avoid needing to make further moves next year. But
so the question, Ksenia, is basically, if you're a trader today, do you see this as like a Fed-type move, or is it like, you know, baby steps, BOJ style?
I think it's a continuation of the hawkish comments that we saw last week from the Fed and the ECB that really jolted stocks, which saw this 2-month tremendous rally from the September lows. We saw some bull markets in Europe appear. We saw the Dow enter bull market. So we saw this tremendous recovery. And last week, the central banks finally made clear that the markets were wrong. Investors were overly optimistic, and they will continue with rate hikes despite the taming inflation. And BOJ is just the latest in a line of these major central banks.
But if it is just the latest, and I don't know, Hugh, then we're going to see a lot more from the BOJ. And of course, the market is also pricing that there's a new governor that could change policy come April.
Yeah, so this is really the big question now. We've heard rumours over the weekend around a change in the accord between the Japanese government and the Bank of Japan. I think this really sets the stage for the next move, which in my mind has to be an increase in that 10-year yield target, which is the next step. Previously, we thought that would have to wait until after the new governor takes over. I still think that's the base case, but markets are now going to be edging forward. It's not clear to me how this solves the Bank of Japan's problem in terms of trying to improve market liquidity, because really all they've done overnight is just bump up the limit at which yields are pushing against, and they're going to be forced to keep buying more and more to try and protect that target.
But again, Governor Kuroda said, look, the yield band is as it is. Do you believe them?
Well, it is for now, but it's that wage growth problem, right? This is where all of the central banks were really wrong in 2022, which is that they misjudged the pace at which wage growth is going to accelerate. And so wages are the key issue to track, but I do expect that Japan now has really met the necessary conditions to be tightening monetary policy. And so it's a question now of just when rather than if in terms of that next step tighter.
Yeah, and Ksenia, we also know, of course, that Japanese investors buy a huge amount of treasuries and European bonds. So what does it mean longer? Is this the story, certainly of the end of 2022, well into 2023?
Yeah, it's crazy because Japan is the world's largest creditor. So in strategists at UBS today said that now there will likely be exit from bonds in the US, Australia, and France as a result of today's move. So we might see more selling pressure there and then more inflows into the yen bonds.
Yeah, so how long does that take, actually? So it makes it more attractive to get money back in the country.
It does, but I would say here, I think if we see a backup in US Treasury yields, that's going to be an opportunity for investors to be adding to fixed income. I think when you look at the path of the Federal Reserve next year, we have much clearer sight now as to where they're planning to end the tightening cycle. And with that, US fixed income looks very attractive at these kind of levels. So if we do see a backup in yields on the back of some repatriation, I think that's more of an opportunity to add rather than something to fade.
Hugh, is this like classic Kuroda? I mean, he's always wanted to surprise the markets, and I don't know whether it's a lesson in really we're doing a lot, but actually not that much. Because it's a surprise, the move is so much bigger.
Yeah, I think this is just the nature of this kind of yield curve control target. One of the most interesting statements from the Bank of Japan over the past few months was when they started to talk about how they would rethink exit strategies before they implement new policy in future. Right. Because you look back to the RBA earlier this year where the market just said, look, we know you're not planning to adjust yield curve control anytime soon, but we're going to do it on your behalf, basically. Yeah. And so this kind of no, 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 and then bang, here we go, you get the move, was really the only way out for the Bank of Japan. I think it's more about the concept of yield curve control than necessarily their policy in particular.
Given the BOJ crack, is this a defeat from the central bank?
Well, yes, inflation was way too high in Japan. So when a very dovish central bank like BOJ comes out with a hawkish comment like today's, it just means that central banks everywhere are forced to fight inflation despite all of their standard policies. And this is just another jolt for equity markets investors out there who were way too optimistic over the past 2 months. We saw yet another bear market rally, which is now coming to a halt. We're seeing the S&P 500, the NASDAQ coming off critical levels. They're now trading below the 200-day, 100-day, and 50-day moving average. And this downtrend might continue considering the hawkish comments from today.
So, Hugh, what does it mean for treasuries?
So, I mean, clearly the pressure on Treasury yields is going to be higher. But again, I think when you're looking at the relative value options within global fixed income today, US Treasuries are the standout market. We heard from the Fed earlier in the month that they kind of knew where they were headed now. You look at the ECB, you look at the Bank of England, you now add the Bank of Japan to the list of central banks, where frankly, there are much bigger questions as to how far they're going to have to move in 2023. So yes, this could add to sort of upward yield pressure across the board, but on a relative value basis, I think treasuries are the standout.
Okay, so how far do you think the Fed will have to hike? And again, it's if you listen to Fed officials, I mean, it's pretty clear, is that inflation may have peaked, but it's not coming down without a little help of interest rate hikes.
That's right. So I think they do have further to go. I'd expect another 75 basis points, so 50 in February and then 25 in March. But I think the Fed now knows that the forward-looking indicators are starting to move in their favor. They just want to see really that coming through in hard data now, and hence they want another few months just to get a clearer sense of the picture, but the direction of travel is much more positive.
And Ksenia, there's been a clear shift in how much the markets are, or when the markets are expecting actually a cut from the Fed.
Yes, exactly. So I think we're now moving towards the second half of next year, because clearly, originally the markets did expect a Fed pivot to come at the end of this year or early next year. But now more and more strategists are saying that we're in for a very rough first quarter, at least for equities. And only after June might the Fed finally pivot and stop hiking rates. Because inflation, yes, it started to ease, but it's still very high. And the Fed doesn't want to make the mistake that was done in the 1970s when they cut rates too early before inflation actually came down.
All right, thank you both for joining us. Ksenia Galuchko there from Bloomberg, and Hugh Gimberg, global market strategist at JP Morgan Asset Management, stays with us. Maybe we'll talk about equities as well. Coming up, EU member states strike a deal to cap natural gas prices, ending months of political wrangling. We'll have all of the details next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, EU nations have broken a deadlock and struck a deal to cap natural gas prices at 180 euros per megawatt hour to help ease the energy crisis gripping the bloc. Well, Bloomberg's Anna Shiraevskaya joins us now. So, Anna, how exactly will this work?
The price correction mechanism will be triggered automatically if the front month European gas benchmark exceeds 180 euros per megawatt hour for 3 working days. And at the same time, the European gas benchmark is more than 35 euros a megawatt hour above global LNG prices. It will be applied from the 15th of February and will be in place for 1 year.
So, Anna, is it going to be effective?
Now, it will be effective in a way of actually avoiding these extreme price spikes we saw in August and September. The level, the proof level of 180 euros per megawatt hour is much lower than the original proposal, and still it is significantly above the current prices, which are about 100 euros per megawatt hours. So we will see how that will actually help reduce price spikes. Now, will it be effective in terms of lowering supply into Europe? That's the biggest concern, because if the prices are higher somewhere else, for example, in China, that supply could actually go elsewhere. So that's the biggest concern in the market at the moment.
So, I mean, there are a lot of concerns. Anna, when do we know if these concerns were rightly concerns because it messes up some of the things that we're trying to do, or whether it goes smoothly?
Yes, Francine. So that also depends on, for example, there is no any cap on demand, and Goldman Sachs already warned today that could actually trigger consumption. And if you have increased consumption but supply doesn't change, that actually tightens the market. And next year we might see even a bigger shortage of gas in the European market. So all attention is now on supply. Will we be able to fill these gas storages in absence of Russian pipeline gas flows? Will actually this price cap try and reduce the kind of spikes, but lower supplies into the region? That remains to be seen.
Thank you so much, Bloomberg's Anna Shiraevskaya there on the very latest on energy prices. Now we're back with Hugh Gimberg, Global Market Strategist at JP Morgan Asset Management. Hugh, first of all, on energy, I don't know whether the energy complex is really being priced in other than earnings. So I know it's part of the earnings complex, but should it have more weighting on equity movements in general?
Yeah, I think what's been interesting this year is that the energy outperformance has really not been a valuation adjustment at all. So when you're looking across the market at areas that could see valuation upside in 2023, I'd put energy as one of those categories. I think what we're also hearing from the news overnight is that this is a sticking plaster, right? This is a temporary price cap that doesn't go anywhere really to solving the medium-term problem. And so when we're looking across the market and trying to find pockets that have been oversold in 2022, climate-focused technology, I think, is one really exciting area for next year. Because the medium-term solution here is not about price caps. It's about changing the energy mix. It's about moving away from gas altogether. And therefore, I think there are some really interesting entry points opening up, particularly if we start to see more stable bond yields next year.
But overall, are equity markets pricing in a global recession? It's unclear, actually, what's being priced in the markets right now.
Yeah, it's a difficult question. I think what we do know very clearly is that everyone is anticipating this recession. This is the most forecasted recession we've ever had. And therefore, to say that equity markets are going to be shocked by this next year, I think is really difficult. What I would say is that when you look across the market now, I think US growth is an area that still stands out as too overvalued, and with an area where you could see some further earnings disappointment. But there are value parts of the market, whether it's in the US or the kind of more value-tilted regions, such as Europe, where I think, there's lots of bad news now in the price. And therefore, yes, it could be a bad year for the economy next year, but it should indeed be a better year for the market.
Are there parts of the markets where you worry about liquidity, like seriously worry about liquidity?
So the unwind of liquidity is still one of the big unknowns. But I think what we've learned over recent months is that the central banks are not going to allow their liquidity reduction to get in the way of their tightening plans next year. So the Bank of England have shown us the model here, which is that interest rate hikes are used to control monetary policy, And really, the balance sheet is about financial stability. So look back to September, October, you get a shock in the UK bond markets, and those liquidity plans are parked. They go very quickly.
I mean, so some of the other, I guess, angles that we're looking at in news is, central bank divergence between, for example, the Bank of England and the ECB. I know they're trying to achieve the same thing, but they're going about it in different ways. How do you play sterling?
Yeah, sterling, I think, is fundamentally weak, quite frankly. And when you look at the Bank of England, they're in a very difficult position now because they've tried to go with this approach of tiptoeing and sort of edging gently to try and control inflation. And you look back at the meeting before last, they were really pushing back on the market's pricing for where they were going to need to get to in 2023. That's now gone out of the statement, but still, I think they have more catch-up to be made. And the challenge is that's going to weaken growth. So I think the backdrop for sterling next year is still pretty weak. I wouldn't want to be playing the kind of weaker dollar trend against the pound. I think the yen or maybe the Swiss franc would be better ways of doing that.
Do you buy any parts of the gilt curve?
I just think you have better opportunities elsewhere, right? If you're looking for a good insight into how central banks are going to behave, you now have that with the Fed. And I think the relative value offered by US Treasuries over UK gilts is very clear.
But on the Fed, much like a lot of the developed world, will really depend on whether the labor market holds strong. And that kind of makes or breaks the housing market and then everything that goes with it.
Completely. And coming back to your first question, it defines whether or not equities have priced in a big enough recession next year, because we need the labour market to slow in order to break the back of the remaining strong parts of inflation, particularly core services in the US. Now, some of the forward-looking indicators are now heading in the right direction. We're seeing some slowdown in wages, but a couple of weaker non-farm payroll prints in the early part of next year would be a really good way to start 2023 to give more clarity about when the Fed can really pause.
So tactically, are there certain sectors that look attractive right now, or do you go for individual company names?
Yeah, so from a sector perspective, I still think you want a bit of a value tilt. So energy is one that we've talked about. I still think the banks have further upside to be priced in terms of this higher interest rate environment. And I'd also think about a lean towards dividend payers. It's one area of the market that's really not performed very well this year, but payout ratios are very low. We've seen previously that high inflation environments tend to be where that kind of income tilt really works. So that would be another way that I'd be looking at adding some defensive characteristics to an equity portfolio when your traditional defensives like utilities or staples or healthcare are the expensive defensives that look a lot more challenging today.
Hugh, thank you so much. Hugh Gimber there, Global Market Strategist at JP Morgan Asset Management. We'll see you in 2023. I love saying that. Coming up, members only. Twitter will restrict voting on company policy to paying Blue members. More details to follow. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. A House committee has recommended Donald Trump be prosecuted for his role in the January the 6th assault on the Capitol. The committee voted unanimously to refer Trump for prosecution by the Justice Department on 4 criminal offenses, including insurrection. It is the first such referral for a former U.S. president, adding to the legal and political troubles plaguing Trump's 2024 re-election bid. Now, European nations have reached a deal to cap natural gas prices at €180 per megawatt hour. It ends months of political wrangling over whether to intervene in an energy crisis that has risked pushing the region into a recession. The cap is significantly lower than an earlier proposal by the European Commission, which would not have prevented the price spike seen earlier this year as Russia curbed gas supplies. FTX co-founder Sam Bankman-Fried's preparations to be extradited to the US do appear to be back on track. Bankman-Fried told a judge in the Bahamas he will end his fight to avoid being sent to the US to face criminal charges over the collapse of his crypto empire. But his local lawyer said he wasn't actually aware of the plan. The hearing was adjourned and Bankman-Fried did return to jail. Now it appears that he and his lawyer are on the same page. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Quite a lot going on. Understatement of the year in terms of that BOJ shocking with a boost to target the yield ceiling. Now, this is what we know so far. Of course, we've had some huge moves across, across the globe, really. We also have the first economist from Bloomberg Economics talking about what he thinks the take overall is. So he basically goes back saying that the move shook the markets, the yen and also long-term bond yields took off, stocks bombed. The implication, of course, we know go far beyond Japan with the BOJ, the last advanced economy holding out in a global monetary tightening shift, now letting the benchmark yield trade higher than before. And of course, the shock will echo across global financial markets, not only for today, not only for the rest of the year, but probably into 2023. Coming up, we talk Twitter, members only. Twitter will now restrict voting on company policy to paying Blue members. We'll get more on all of this with Richard Windsor, Radio Free Mobile founder. That's coming up shortly, and this is Bloomberg. BOJ, a shocker. Governor Kuroda stuns markets by adjusting his yield curve control policy, signaling the central bank may be inching towards normalization. Traders jolted. The Bank of Japan surprise sends the yen to its strongest level since August, while government bonds and global equities slump. Plus, criminal charges. A House committee recommends that Donald Trump should be prosecuted for his role in the January 6th assault on the U.S. Capitol, the first ever referral of a former president. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So we continue with today's big story. That's the BOJ's surprise move. Let's bring in our markets reporter, Valerie Taitel. So, Valerie, good morning. Talk to us about some of the broader impact, of course, of the BOJ's move.
Yes, thanks, Francine. I want to talk about what happened in Japanese front-end rates. Kuroda, again and again in the press conference, tried to say that this is not the beginning of a tightening cycle, that this shouldn't be viewed as a rate hike, but the market clearly took it the other way. 2-year, 1-year swaps, it's a good proxy for where forward interest rates will be in 2 years' time, rose nearly 20 basis points. This is the beginning of the market really pushing on the Bank of Japan. They are trying to price in a full hiking cycle. We might not really get that signal from the Bank of Japan until April. That's when Kuroda steps down. But this is a big deal, Francine, and I'll tell you why. A lot of Japanese investors own foreign assets. They're one of the biggest holders of treasuries. When moves like this happen in the front end, the way that they hedge their assets to bring them back home, to bring the returns on their assets back into Japanese yen, they start to look less attractive, meaning treasuries, bunds, gilts, all these things which we know Japanese life insurers hold could look vulnerable to repatriation of flows.
Yeah, so how long would that take? And if you look at globally, are Japanese investors actually big enough to have a big impact on markets?
Yeah, so Japanese investors, they're very large pension funds, and we know that they move slowly. So this could definitely be a story that could eke out over Q1, Q2, or maybe all of 2023. But definitely, if you look just at the life insurance industry, $3.5 trillion of assets they own. And as I mentioned, they are the largest foreign holder of treasuries. They're also very involved in bunds and gilts. So if we start to see just a small asset reallocation, there could be huge pressure on these global yields to rise as they repatriate it back into JGBs.
All right, thank you so much, our markets reporter, Valerie Taitel. Now, Elon Musk says Twitter will restrict voting on major policy decisions to paying Twitter Blue subscribers. That comes just a day after 10 million people, or 57.5%, voted for Musk to give up his role as head of the social media company. Well, Alex Webb of Bloomberg Quick Take and Richard Windsor, founder of Radio Free Mobile, joins us. Well, they both join us, actually. First of all, Alex, just run us through what happened. So there's this poll saying, like, I will abide by it. If if you want me to step down. And then people voted for him to step down, and he says, I'm going to change the rules.
Yes, exactly. You've characterised it shortly what's happened. He also then responded, look, we can only guess what he's sort of thinking by his tweets. There are a number of tweets from people saying that, oh, this looks like maybe some bots contributed to this voting.
Yeah.
Therefore, perhaps you should change the voting system so that actually only people with verified Twitter Blue accounts can contribute to these sort of things. Is he trying to back out of it? Quite possibly. The kind of focus here that we need to look at is really Tesla stock, because that's the main thing that actually has an impact in the public markets.
Yeah, Richard, have you been banned from Twitter yet?
No, not yet. I think though this was the way we look at this is that it was basically resignation by remote control. I think he had a very good idea of what the outcome was going to be before he decided to actually put the poll on Twitter. And I think he's done it pretty much as the other guest mentioned, is he's receiving some heat from his shareholders. He's not paying enough attention to Tesla. The performance of the stock has been terrible, so he really needs to refocus back where his attention is needed.
But do you think, Richard, that he'll step down? And does it really make a difference if he steps down? Because he's still majority shareholder, he's still going to be in control. I
think that's exactly right. I think you hit the nail on the head. I think he will step down. I think he will appoint another CEO. But at the end of the day, he is the majority shareholder. He controls the company just like Mark Zuckerberg controls Meta. So I don't think in terms of policy an enormous amount will change. What might change is the nature that policy is implemented. Since he took over, it's been very haphazard, a little bit crazy, up and down, back to front. I think that it may become more organized going forward.
Alex, him no longer being chief executive doesn't mean that he won't tweet.
No, and it doesn't also, as Richard suggests, it doesn't mean that he's not going to be very hands-on. He's just put, well, he's not personally put 44 billion in, but the sticker price was $44 billion. He's got a heavy, vested interest in this company succeeding. That also poses some of the challenges. Well, who's going to come in as CEO, chief twit, as Elon likes to call it, if you've got Elon breathing down your neck constantly? I think the key thing here is, though, if you look at Tesla shares had gained a little bit on the expectation he would step down. Since then, they have paired some of their gains with perhaps the market sort of realizing some of the realities of this, that he's not immediately stepping down, one, and secondly, he's likely to still be heavily involved no matter what.
Can you imagine being chief executive with Elon Musk as biggest shareholder? Richard, would you do it?
That's a good question. My favorite choice is actually Sheryl Sandberg. Number one, she's had Mark Zuckerberg breathing down her neck for more than 10 years, so she's used to it. And two, she did such a great job at monetizing the Facebook app when it went mobile. I think she'd be a great choice.
But Richard, how do you monetize Twitter right now? And I know we're getting also bogged down. Like yesterday, I couldn't believe it. There were icons that were square and not round, and it kind of put me in all sorts of tizzles and frazzles. How do they get back on track?
The problem is Twitter, as it exists today, is actually very well monetized. It generates an awful lot of revenue for what it really does in terms of traffic. So the answer is you've got to think of something else. Subscriptions is a possibility. I actually looked at this possibility years ago, and it is viable from Twitter's perspective, not from Google or Facebook's perspective, but Twitter, you can actually do it. That is one way of doing it. The other way, of course,
is this a good business? Yep. Alex, is this a good business?
Twitter has 10% of the users of Facebook, and each of those users generates 10% of the revenue. So the average revenue per user at Twitter is 10% that of Facebook. So that perhaps is what Richard alludes to when he talks about the possibility of having a subscription model. The upside of bringing a subscription model in is greater for Twitter than it would be for Facebook, which generates in the order of $200+ per user per year in the US. That means that it's generating significantly more than $10 a month from each user. If you're looking at a $10 a month subscription for Twitter, that's upside. It would not be for Facebook, so that's why the difference comes in.
Sorry, Richard, I rudely cut you off.
No, sorry, I was going to say was the other opportunity is this whole super app business that he has mentioned a couple of times. This really is a cut and paste of WeChat. WeChat in China is effectively used for running almost your entire digital life. And if it can internalize all sorts of other activities inside Twitter as a super app, then the monetization opportunities will be greatly enhanced.
I mean, that is a tremendous opportunity if they get it right, but there are sort of three obstacles. You have the you need developers building for that platform. They have far fewer users than do Facebook, than do Apple or Google. That's where developers are going to concentrate their efforts. And secondly, you need a payments tier to glue all this stuff together. That's a huge ask. It was maybe a bit easier when Jack Dorsey was CEO because he's got the block relationship. And thirdly, regulators do not like it when you leverage strength in one market to generate strength in another one. That's why Google's paid billions of dollars of fines over the past decade or so. That is the entire business model of a super app. You're taking one strength and generating another out of it. So if anybody could do it, maybe it's Elon. It's still a big ask.
Yeah, but Richard, at the same time, you need to trust. I mean, anything that's with banking, you need to trust, right? You need to trust that you don't get kicked out of the platform. You need to trust that you're, that somehow it's not a volatile environment that Twitter currently is. So if there is still ambitions to be a super app, how long does that take, given the current situation of Twitter?
I think it could take a very long time. I mean, it took WeChat the best part of 8 years, and I think Alex is absolutely right to identify those hurdles, and the hurdles are, quite frankly, massive. And you can't just say, hey, because it works in China, it's going to work in developed markets. And again, you're absolutely right to point out the whole payments issue is going to be very, very important. And so it'll take a long time. It's by no means a certainty. So, my balance would probably just say it wouldn't work, but it is an opportunity for him to actually return some value for the 44 billion invested.
I suppose one thing that we're sort of omitting here is we haven't spoken about advertisers. If you're going to build a product like this, you need to pay the bills you currently have. Twitter has something like in the previous 12 months, $3.5 billion a year in running costs. It also has on top of that now $1.2 billion in debt that needs to service. Advertisers are fleeing the platform. If you firstly need to retain those guys, need to keep with the money coming in, then that gives you the base on which to start thinking about these slightly more ambitious projects. And at the moment, the basics are not being done well.
Richard, I'm a subscriber to your newsletter, which I have to say is fantastic. And overall, of course, every day you talk about Meta and some of the other technology companies. We've seen a number of job losses across the board. What's 2023 going to be like?
I suspect 2023 is going to be a little bit more of the same, certainly in the first half, and I think a lot depends on what happens with interest rates. Now, the last couple of CPI inflation numbers have been a little bit encouraging in terms of inflation starting to come back, so maybe things start to stabilize in the second half. So I think you could see a difficult first half, maybe things start to stabilize in the second half, and we start to see some demand come back from the consumer now that inflation hopefully would be on the back burner.
There's a key number when it comes to the job cuts, and if you look at Amazon and Meta in particular, they might have grown revenue significantly until this year. Meta's slowing down a bit, but grown revenue significantly over the past few years. But a number that has actually come down is revenue per employee. So that both Amazon and Meta, and this isn't the case with Microsoft and Apple, they significantly expanded headcount faster than they could grow revenue. Then we've seen the share prices come down, partly because of those interest rate factors that Richard was talking about. And so they're looking to say, well, what can we correct? Let's maybe correct this over-hiring piece. Now, that's incredibly tough on the employees. It's not their fault, but it's the bosses kind of correcting some of their missteps. All
right, thank you both for really a great panel. We'll get you back on together again. Alex Webb there of Bloomberg Quick Take, and Richard Windsor, founder of Radio Free Mobile. Now, coming up, more on the Kuroda curveball. The Bank of Japan shocks markets with an adjustment to its yield curve control program. So we discuss the changes, and of course, we talk about the market reaction. That's coming up shortly, and this is Bloomberg.
The volatility of the financial and capital markets seems to have declined temporarily, but it has increased again recently. The distortion of the yield curve has become very strong, so we made some adjustments today. This is just to ensure that yield curve control functions steadily and does not mean a beginning of a rate hike, tightening monetary policy, or reviewing YCC.
Well, Well, that was BOJ Governor Haruhiko Kuroda speaking after the central bank stunned markets by doubling a cap on 10-year yields, allowing them to rise to around 0.5%. Now, the BOJ's move caught most traders off guard, with Japanese bond yields soaring to the highest since 2005 and the yen surging more than 3%. Now, the shift could mean a rise in global borrowing costs as higher yields also lure Japanese capital back home. Now, while the effect ripples across global markets, at least 3 funds stand to benefit from the BOJ's move. Blue Bay Asset Management is one of the funds correctly betting that Japan's central bank would relax its long-held cap on bond yields. Russell Matthews, senior portfolio manager at Blue Bay Asset Management, spoke with Bloomberg TV a bit earlier.
Now you face higher bond volatility. I think yields will need to rise in Q1. And we will stick with our short and JGBs for the moment, and just see how things play out and where levels get to. The other thing that I'll emphasize as well is that higher bond volatility, higher rates, more hawkish central banks, this all is not good for risk. And so, we've been cautious and have been taking down risk in general in the lead up to this. And I think now equities look like they are going to be potentially under some pressure here.
So, Russell, I want to follow up on a couple of things you said there. One is you're going to stay short JGPs because it's not too much negative carry, and even though you think it'll be tougher from here, it's an easy one to hold. But surely if you're saying there'll be higher yields, that'll make the yen trade harder. Does that mean that the easiest expression of this from here is actually to short global equities? Like, probably shorting E-minis is probably the cleanest play from here. Is that the way what you're kind of saying?
Well, not being an equity guy, I'm not going to, promise to be an expert on that, but that does seem to us to be a pretty obvious trade. I agree. But I think in the FX market as well, on the yen, I think that the yen will appreciate from here. We can look at 130 as a definite near-term target. But away from the yen, I think the combination of this more hawkish central bank a message is coming through, and I also just add in that the RBA was pretty hawkish this morning as well. So we've had this raft of hawkish central banks, and so away from the yen, I think that the dollar now comes back into focus. We've had a lot of speculation and anticipation that the period of dollar strength is over, and the market looks in much better shape for 2023.
Well, that was Russell Matthews, Senior Portfolio Manager at Blue Bay Asset Management, speaking earlier with Bloomberg's Danny Berger and Mark Cudmore. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. FTX founder Sam Bankman-Fried has caught his lawyer off guard with his plan to waive his right to fight extradition to the U.S., where he faces charges including wire fraud. Bankman-Fried's Bahamian lawyer told a Nassau court hearing he was now aware of that plan. The judge then adjourned proceedings until February, with Bankman-Fried ordered to return to prison. Now, the European Commission has warned Meta of a possible breach of antitrust rules over its marketplace service. The Commission says the company may be squeezing out classified ad rivals by tying the Facebook marketplace to its very own social network. The move paves the way for potential fines or changes to the firm's business model. The EU regulator has been investigating Facebook since 2019. Chinese banks have maintained their benchmark lending rates for a 4th month after the central bank last week kept its monetary policy settings unchanged. Some economists had expected a 10 basis points cut in the 5-year loan prime rate to help the embattled property sector. The PBOC has kept its key MLF rate unchanged since August, treading cautiously as officials abruptly lift COVID restrictions. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Coming up, the Kuroda curveball. The Bank of Japan shocks markets by adjusting its yield curve control program. So we'll get more on that and what to expect from central banks going into 2023. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition of Francine Lacqua here in London. Now, the Bank of Japan, you all know by now, has shocked markets by adjusting its yield curve control program. The central bank will now allow Japan's 10-year bond yields to rise to around 0.5%, up from a previous limit of 0.25%. The change sparked a jump in the yen and a move higher in Treasury yields. Now, for more, we're joined by Jamie Rush, our chief European economist at Bloomberg Economics. Jamie, I mean, I love this story. You probably love it less if you're a market participant. You're probably hiding under your desk if you're on the wrong side of the trade. But actually, is this policy normalization, or is this just, financial mechanics?
Well, I think I think what we need to recognise is that Bank of Japan faces a policy trade-off.
Yeah.
So it wants inflation to be higher on an underlying basis in Japan. It wants super loose monetary policy, but that's causing a conflict with the Fed, who are obviously moving in the opposite direction. It's got yen depreciation, which it just doesn't like. So I think we should be thinking about it as a recalibration within this policy trade-off, rather than the start of like a major hiking cycle.
But so what does that mean fundamentally? If it feels, right, the market is repricing everything because they were the last fort not to do much, and even them are like swept in this global hawkish stance.
Yeah, and if you interact that with the change in leadership that's coming in April,
right,
then I think that's exactly right. So you don't know where this is going to end. And we've seen it happen at the Bank of England, we've seen it happen at the ECB, where what starts as a little chipping away becomes something fairly significant fairly quickly.
So, Jamie, talk to us also, I mean, what a lot of people kind of are now remembering, but maybe didn't realize overnight, is that Japanese investors and pension funds are huge. They're some of the biggest holders in treasuries, but also European bonds.
Yeah, I mean, so we're seeing a shift in the relative attractiveness of Japanese and European assets, right? And I think at the margin, it's going to make a difference. We're already seeing bond yields rise in Europe, which obviously complicates the ECB's task, for example. But I think we should remember the scale here. Unless there is a big change in policy at the Bank of Japan, yields have risen by far, far more in Europe than Japan.
So what does this BOJ move mean for the other big central banks?
Well, I think it just adds to the list of things to worry about slightly, doesn't it? So the asset prices are vulnerable to central bank policy, both at home and abroad, and we've just seen an additional risk put on the table with the Bank of Japan.
So the most interesting, I guess, bit in 2023 is, again, how markets interpret what Fed officials are saying. We could reach peak inflation, or maybe have even reached peak inflation, but be nowhere near the end of hiking.
Yeah, so I think our view is that we probably have reached peak inflation, Fed, Bank of England and ECB in all three economies. And what we'll see probably is just a bigger emphasis on core, on the labour market, and much less emphasis on the risk posed to inflation expectations from headline. So I think that's the shift in focus that's going to happen. And we're going to see that kind of different inflation outlooks appear in 2023 based on those domestic circumstances.
But so, Jamie, what's the most difficult thing for you guys going into 2023? And you've been putting some really fantastic research out. Is it to see the difference between what the markets are thinking and what policymakers are saying? Or is it really more economics, kind of what the housing market does if the labour market crashes?
Yeah, so I think that, the housing market is one of the potentially pivotal things for 2023, isn't it? So you've seen globally asset prices have revalued as the interest rate environment has changed. That hasn't really happened yet in housing. And so it's how that plays out. Will it happen fast? Yeah. Will it happen slow? And we've seen in Sweden that you don't need the unemployment market, the job markets to tank for house prices to fall. So I think that you're right to flag that as a major risk.
But do you think we've reached peak inflation across the world?
I think so, cautiously. It's one of those things that you could say.
Just put on the spot.
You can say that 100 times this year and be wrong. But no, I think genuinely, unless there is a big further major shock on the energy markets, then I think we're probably there.
All right, Jamie, thanks so much. Jamie Rush there, our chief European economist at Bloomberg Economics. Now, Bloomberg Surveillance Early Edition continues in the next hour with Anna Edwards in New York, Danny Berger in London, and this is Bloomberg.
Central banks are telling us inflation is stickier than what the market is anticipating.
This seems to suggest that the political pressure is coming to bear. That's the increased probability that the Bank of Japan will be under pressure to bring in a new governor who will raise rates and get us out of this insane experiment.
It's probably a little bit early to call that we're moving to a full normalization, but this is a big deal and has the potential to spill over into other areas.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. A surprise move by the Bank of Japan has the yen surging. The BOJ shocks markets by doubling a cap on the 10-year yield. Now it's up to the Justice Department. A House committee recommends that former President Trump be prosecuted for his role in the assault on the Capitol. And Elon Musk has second thoughts. The Twitter owner says only paying members will be able to vote on major decisions, following a poll calling on Musk to step down. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Anna Edwards in New York. Matt Miller is off, and Kaylee Lines is taking a much-deserved sleep-in, hosting the U.S. Close show later today. And Anna, here we thought it would be a boring week. We could just saunter into the Christmas period, but it is Christmas come early for the macro traders with the BOJ surprise.
Yeah, so much for the quiet week then ahead of the holidays, Danny. We certainly have some massive moves on markets to talk about, driven by the BOJ. Let's check out what was happening in the Asia session then, and this the epicenter of today's big news story around the BOJ. Are we starting to see the final piece of the global rate tightening cycle falling into place? Is that too extreme? Certainly the BOJ sees it differently. Governor Kuroda saying that increasing the bandwidth for the 10-year JGB to trade in is not the start of monetary tightening, but the market sees it a little bit differently and does seem to be pricing it in that way. So this is the Asia Pacific equity market, not down all that much, but the focus very much on Japan, as you see, down by 2.5%. If money is going to become increasingly expensive, if we are losing that funding currency in the shape of what's been going on with the Japanese yen, if that's going to be part of the narrative into 2023 or a little earlier than anticipated, then that is bad news for stocks, it would seem. The dollar against the yen, certainly worth mentioning. The yen then strengthening by 3.4%. Maybe the yen could have done with this help back in the middle of 2022, according to some of our colleagues on Markets Live blog. And maybe we need to see more of this. If the market was short yen, do we need to see more yen short covering as a result of what we've heard from the BOJ? The Japanese 10-year yield also moving on this. We see higher yields as a result of the market saying, well, we hear you, Governor Kuroda, but we think actually this is a start of something when it comes to yield curve control and move away from the policy that we've had up until now. Let's have a look at what this does to the US asset picture. And this is not just a Japanese story by any stretch. We're off earlier lows on S&P futures, but certainly our colleague on the Markets Live blog, Mark Cudmore, earlier on saying maybe actually through global stocks, this is this kind of purest way to play this risk-off move that we've seen from the BOJ, because maybe the yen-JGB relationship gets a bit complicated. We're certainly seeing the Treasury market taking this very seriously. So we see movement in 10-year yields higher. We see 30-year yields going higher. And this is, of course, because of the role that Japanese investors play in the Treasury market. And if they have more incentive to go back home, to repatriate that currency, then as a result, that leads to decreased demand for the fixed income products of the US government, as you see. Bitcoin, one of the only assets today not moving on this story, Danny, but it's in here nonetheless. 16,814 is where we trade, up by 1.4%. And I know that the BOJ news has been rippling through European markets, bond markets in particular, Danny.
It really has. I will kick us off with equities because much like the U.S., the worst of the losses have pared back a bit. Perhaps it does have to do with Kuroda saying that this is not abandoning easy policy, saying that they won't widen the band even further. But either way, much like you were showing, Anna, the ultimate impact is one of tightening financial conditions. If yields are moving higher, that means stocks sell off. Now, some regions are worse than others. For example, the FTSE 100 and the IBEX are basically flat. So it is the higher beta stock markets that are selling off, again, with this idea that it's the ones more exposed to the rate story. And again, along with just this idea with tighter financial conditions, it is funding currencies, the yen funding currency, which is taking a hit. If we lose that, then yes, as you pointed out, Anna, there are trades that perhaps need to unwind. Euro yen and sterling yen, both of those depreciating pretty significantly today, at least 3% versus the yen. Not only is it a story of losing some of these funding currencies, because after all, I mean, this carry trade, it's always been picking up pennies in front of a steamroller, and the steamroller arrived arrive today. But it is also, Anna, as you pointed out, this idea of repatriation of funds. Japanese investors held so much of the world's sovereign debt. If all of a sudden you can get a yield at home, you need to readjust. So we are seeing German 10-year yields. Those are moving up by almost 8 basis points. And Anna, it is across the European sovereign space. We are seeing bonds take a hit.
Okay, so we're certainly seeing this across Europe. We're seeing the impact on the Treasury market. Let's talk about the BOJ and the move today. The BOJ's surprise move has roiled global markets, but at least 3 funds stand to benefit. UBS Asset Management, Schroders and Blue Bay Asset Management. Earlier on Bloomberg, we heard from Russell Matthews, lead portfolio manager at Blue Bay, which had long predicted the BOJ's hawkish shift.
Do we think that this is just an isolated move? Absolutely not. This is the beginning of normalization. They've been increasingly struggling to hold, their hard policy mix, the emergency policy mix. That's now sort of changed, and we're on the pathway to normalization, and the market is going to be pretty volatile as we progress along that path.
Russell Matthews there, a good day for Blue Bay, and he was making those comments on Danny, on your earlier show, I know, with Mark Cudmore. Let's get to Paul Dobson, Bloomberg Executive Editor for Asia Markets, the perfect voice to speak to this morning on this subject. How significant for you, Paul, are these moves? Because we hear that the BOJ downplay the significance of this, saying this isn't the start of a tightening cycle, and even some economists saying, look, this is just a very small move, doesn't necessarily mean that we are seeing any kind of full tightening from the BOJ. How significant would you describe this move as?
I think very significant indeed, both for local markets and for global markets and for monetary policy in general. Anna, I think, the BOJ may protest and may say this is all about ensuring that the bond market functions normally, but the market isn't going to hear that at all. The market's takeaway is we know that at some point the BOJ needs to start getting towards normalization. Inflation is above its target. We're waiting for that sign of wage growth to come through, and if we get that, then the BOJ may need to, start to relent on this incredibly easy monetary policy that we've seen in place for such a long time. So, first sign, first sniff of danger, first hint that there's a move, the market is going to latch onto that, and that's what we saw in trading today with that big repricing of the government bond yield curve and then the yen as well. And comments like you had from the likes of Blue Bay saying, yeah, we like this trade, we were already on this trade, we're going to do more, we're going to go harder. We think that this is, a trend that we can get onto now. Shows you that the market is going to push. I think the BOJ will reiterate that it wants to be patient. I think the Japanese government will also talk about this in very measured, slow, baby steps, a story for the whole of next year. But the market will be impatient, and we know that it will push and test and probe every step of the way now that we've seen that first little hint that the BOJ is ready to relent.
Yeah, Kuroda trying to be very clear, saying that this isn't them abandoning easy policy. Paul, no economist surveyed by Bloomberg thought that this would happen today. We're in this really illiquid period. It is the run-up to holidays. What do you make of the fact that this happened today, that this happened now? What do you make of the timing?
Yeah, I think surprise is important when you're making a big shift in monetary policy in a way. As if you were to give a signal that it might be coming, the market would take it as read that it was already coming. So why not go there, get out ahead, own that conversation, own the discussion like the BOJ managed to do today. It reminds me very much of when we were covering the Swiss bank way back when it had its cap on or a sort of limit on the Swiss franc's appreciation, and it had been telling us up to the week before there was no way that it was possibly going to relent on that, and then it pulled it away, surprise first thing, kind of in the morning without giving any indication that it was going to happen. I think that's the way that policymakers have to make decisions when they've got such a sort of ingrained policy in place. No point in hinting, or the market will take you down anyway. Better to get ahead of the market and announce and own it. And so that's why I think this surprise came. But I think it also has one other benefit, which is that by Kuroda sort of taking the hit, as it were, by saying, okay, we're going to make this move, then when he steps down in April next year and is replaced, it makes it just that little bit easier for the next BOJ governor to come in and think, okay, all right, new shift in policy, maybe we get towards a tightening cycle from here.
Paul, thank you so much. Bloomberg's Paul Dobson. Those with long memories reminding us this is a bit like 1989 from the BOJ. We'll get back to those comparisons later in the programme. Let's pivot to US politics. It is now up to the Justice Department to decide whether to prosecute Donald Trump for his role in the January 6th assault on the Capitol. A House committee voted unanimously to refer the former president for prosecution on 4 criminal offences, including insurrection. Democrat Representative Jamie Raskin of Maryland spoke at the committee meeting.
We proposed to the committee advancing referrals where the gravity of the specific offense, the severity of its actual harm, and the centrality of the offender to the overall design of the unlawful scheme to overthrow the election compel us to speak. Ours is not a system of justice where foot soldiers go to jail and the masterminds and ringleaders get a free pass.
Emily Wilkins joins us, Bloomberg government reporter in DC. Emily, the significance of this move then from this panel, it doesn't necessarily have legal weight, hence why it's up to the DOJ now to decide its next move.
Yeah, the ball is absolutely in the Justice Department's court, and they've already begun moving on it. They do have a special counsel, Jack Smith, that was hired specifically to look into Donald Trump and his actions around attempts to overturn the 2020 election. Certainly, the Justice Department will be using materials that this January 6th panel have gathered over time. They've been working now for more than a year. They've done thousands of interviews at this point, and we're going to be getting a 161-page report from them, really detailing a lot of the stuff that they can make public. And that's really going to go into whether the Justice Department will be bringing charges forward. But clearly, this has already had an impact. If you look at the 2022 midterms, if you look at the candidates who most closely mimic Trump when talking about the 2020 election, none of them did very well ultimately in their races. And it's sort of just a signal from the American people. Most Americans are tired hearing about this. They don't believe that it's accurate, and they want the government to focus on other things. And it seems like if these charges continue to be something that come up for former President Trump, that could have a very big impact on his bid to be president in 2024.
Yeah, get into that a bit, Emily. What could happen that could change his ability to run for president?
So there is one of these charges, with the charge about aiding or assisting with a conspiracy. If Trump is charged, he hasn't been yet, and if he is found guilty and convicted of that, that would effectively bar him from holding the White House and holding that executive office. And so that is something that it depends exactly how quickly this case moves. Obviously, the legal process can take some time, but it's a huge thing that is hanging over Trump's head, and probably something that Republicans are thinking about as they move forward with deciding who their nominee is actually going to be. Other than that, it's really just going to be an impact in terms of the fact that these charges were even recommended and referred in the first place, as well as just everything the committee has rolled out. I mean, these have been highly choreographed hearings. There's really been a lot of thought and production value that's gone into it, all of it in the name of really convincing the average American individual that Trump had a very clear role in what we saw unfold on January 6th, and just how serious this was in terms of what his actions were and what the potential results could have been.
Yeah, well, it will definitely be interesting to see in the years ahead how this impacts public opinion for those presidential elections. Emily, thank you very much. Emily Wilkins of Bloomberg Government in Washington. Now, Elon Musk says Twitter will restrict voting on major policy decisions to paying Twitter Blue subscribers. That comes just a day after a majority of the 17.5 million votes cast in a poll were in favor of Musk stepping down as CEO. Joining us now is Bloomberg intelligence analyst Matt Bloxham. So, Matt, the poll spoke. Elon Musk said he'd abide by it. I mean, is this him backing away from it to some degree to say, oh, no, we only want paying members to have a voice?
Yeah, it's a good question, because obviously that announcement was made specifically around policy decisions. But yeah, there's this big question now about whether he's going to change the terms of reference for that poll about him staying on as CEO or not. To be honest, I think it's a bit of a sideshow, because whether he's CEO or not, he's clearly going to be the guy making the big decisions about Twitter's future, whether it's as officially CEO or just in the background. Yeah, he's had this obsession with Twitter as long as we can remember, even before he bought it. So I think, that's not going to change his influence over the company.
Yeah, Matt, good morning. Does the market think that he's going to step down? I mean, how do we gauge that? There's no Twitter share price anymore. I guess the Tesla share price tends to give us a bit of a view.
Yeah, exactly. And the Tesla share price was a little bit up and down yesterday. Ended more or less flat on the day. So I think that's probably the best kind of public market proxy you've got to the sense about what's going on. And maybe to some degree the fact that it ended up not really moving very much tells you that there is this sense that whether he has the official title or not, he's still going to be very focused on what's happening at Twitter in the coming months and years.
OK, thank you, Matt. Matt Bloxham joining us there with the latest on Twitter from Bloomberg Intelligence, of course. Coming up on the programme, we're seeing a risk-off environment today. We're off earlier lows on stocks, but US futures flat to negative this morning, down by 0.3% on the Nasdaq futures. And we will talk about that with Maria Weitner. This is the global impact of the BOJ's move. State Street Global Markets senior multi-asset strategist. She joins us. What impact on her assets as a result of this? And again on the BOJ's surprise move, Derek Halpenny joins us. MUFG head of research for global markets, EMEA and international securities. We'll get his take on the yen, the bond markets, the JGB markets, and what this does to treasuries as well, because this does have a global footprint, this story. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Anna Edwards in New York. Now, we got the BOJ shocker this morning, doubling the upper band. And I want to talk about this idea of why now. Why would they change this now? Kuroda says it is to preserve market stability in order to transmit easy policy. However, the chart I have here for a radio listening audience is Japan inflation. It has been above Japan's 2% target since April. Yes, Kuroda says that he doesn't think on an annual basis it will get to 2% in 2023, but perhaps they are feeling the pressure from, again, inflation, which is running hot. And this is part of the reason why the market is struggling to believe the BOJ. So what will be the impact of that? Joining us now is Ksenia Gluchko, Bloomberg Equities editor. Ksenia, if this is a market that doesn't believe the BOJ, if this is the first step to abandoning yield curve control, what does this mean for a global bond market?
Well, this has been a total shocker, and none of the economists in the Bloomberg survey expected today's news. This is quite bad news for global developed bonds, which will be under pressure from this action as money flows back to yen and Japanese government bonds. And we saw the yen surge today as a result of this decision. So American, French, Australian bonds are likely to be under pressure from this. Now, rising bond yields is bad news for equities also. So equity investors were hoping for a reprieve after bond yields started coming down in the second half of this year. They were hoping there would be a reprieve for tech stocks, but that is just not happening. And this latest action is going to add pressure on equities.
Yeah, Ksenia, so it's interesting. The fixed income story then is about repatriation, about Japanese investors selling some global bond market products and buying JGBs instead, I suppose. But what about, where does that leave? So that's what's happening in fixed income. What about stocks? Because we seem to be actually off earlier lows on stocks. Yes, E-minis are down, but just 1/10%, Ksenia. So how damaging is this in terms of tightening global financial conditions and making it harder to make arguments to own stocks?
Yes, I thought that was very interesting because we started off this morning with quite a sell-off in European and U.S. equity futures, but they have now trimmed those declines, and U.S. futures are pretty much flat at this moment. I think Kuroda's statement that this does not equal a rate hike has really helped the sentiment. At the same time, we have seen quite a sell-off last week, which paired about half of the gains that we've seen since September lows for the S&P 500. So we can say that some of this negative sentiment has already priced in because of the very hawkish comments from the Fed and the ECB last week, which reiterated their commitment to rate hikes. So this latest statement from the BOJ possibly could already be priced in equities. But in general, if you look at the chart for the S&P 500 and the NASDAQ, they are trading below their key levels of 200-day moving average, 150-day moving averages. The downtrend continues. So the stocks are likely to stay under pressure or trend in this narrow corridor because we're also entering the holiday season and the volumes are likely to drop.
Yeah, despite the BOJ's denial then, interesting to see whether the NASDAQ does drop below that long-term trend line then that kicked in March 2000. 2009. Ksenia, thank you very much. Bloomberg's Ksenia Galushko. And for more market analysis, check out the Market Live blog. MLIV Go is the function to use on your Bloomberg terminal. Plenty about the BOJ on the blog this morning. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in New York with Danny Berger in London. Now, keeping you up to date with news from around the world, here's the first word. In the UK, more labour problems for the National Health Service this week. Nurses are on strike today after their first walkout last week. The Royal College of Nursing says it has a mandate from members to continue action for 6 months unless their wages are raised. Meanwhile, ambulance workers are set to strike Wednesday. FTX co-founder Sam Bankman-Fried's preparations to be extradited to the US appear to be back on track. Bankman-Fried told a judge in the Bahamas he'll end his fight to avoid being sent to the United States to face criminal charges around the collapse of his crypto empire. But his local lawyer said he wasn't aware of the plan. The hearing was adjourned and Bankman-Fried returned to jail. Now it appears that he and his lawyer are on the same page. And negotiators in Congress have agreed to a $1.7 trillion spending bill. Now they'll try to ram it through the House and Senate to avert a government shutdown on Christmas Eve. The bill provides funding for government agencies through next September. It also includes more than $45 billion in aid to Ukraine. Coming up, we will talk to Maria Weitmaner, who joins us, State Street Global Market Senior Multi-Asset Strategist. What does she make of the overnight surprise from the BOJ? A big impact on FX markets and bond markets. What's in store for global equities? We'll get into that conversation shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A surprise move by the Bank of Japan has the yen surging. The BOJ shocks markets by doubling a cap on 10-year yields. Now it's up to the Justice Department. A House committee recommends that former President Trump be prosecuted for his role in the assault on the Capitol. And Elon Musk has second thoughts. The Twitter owner says only paying members will be able to vote on major decisions, following a poll calling on Musk to step down. Welcome to Bloomberg Surveillance, the Early Edition. I'm Danny Berger in London with Anna Edwards in New York this week. Matt Miller is off, and Kaylee Lyons will be on air later hosting the U.S. Close show today. And Anna, it is a market that continues to reel from a surprise from the BOJ. Kuroda says that they're keeping their policy easy, that this is not a change, but the market's certainly reacting like this is a change.
Yeah, absolutely. The BOJ saying this is about increasing the sustainability of the yield curve control policy. So if you increase the band, it means we can keep it for longer. The market says, is it really about that, or is it the beginning of the end of the yield curve control policy? So there's a lot to talk about there. And in terms of the impact on global assets, Danny, there is a lot to discuss, because the yen often used as a funding currency. What does that therefore do to other global assets? For example, stocks. S&P futures then are a little bit weaker, off earlier lows. We had seen a lot more selling of global stocks as a result of this BOJ surprise move. And it is a surprise. The BOJ has a habit of surprising us. It has a history of surprising us. We'll get to that in a moment with our guest, Derek Halpenny. But this is where we are on US equities then. Not a big movement there. We are seeing big movement, I know, in the Japanese currency market and indeed in bond markets. Here's some of the movement we see in bond markets. These are the moves higher in the US 10-year yield, the US 30-year yield. So this is not just a Japanese story, which is important to mention. And the reason for that is because Japanese investors are such big holders of global bonds. And so if there are more reasons for them to send that money back home, then you might see them selling treasuries. And that's what we're seeing in today's session. Bitcoin up by 1.3% for what it is worth. Let's move on and show you what's going on pre-market movers. Tesla is one stock in focus once again. We were talking about this one yesterday around the Twitter story, and the focus on that continues. Senator Elizabeth Warren has been pressing the Tesla board over the actions they're taking around Elon Musk and Twitter, kind of trying to establish whether the board is putting in place sufficient management structure to distance the company from what she sees as a CEO who is distracted from running the Tesla business. Disney pretty unchanged, despite the fact that we've seen the Avatar debut, a little bit bit tepid. The stock hitting the lowest, though, since March of 2020. So there has been some downward pressure on that stock. And Meta in the social media space, Zuckerberg saying that he, well, defending the business essentially against some legal claims. Those legal claims have suggested that the business is trying to profit at society's expense. So it's a sort of ESG vibe to these legal claims, and the management of Meta pushing back against that very much. So, Danny, back to the BOJ and the impact on global markets.
Yeah, I was going to say today, Anna, despite some of the movement underneath the surface, on a surface level, it is yet again a macro story. It is happening in what is usually a very quiet week. You'd have to assume as a macro trader, even as an equity trader, you really just can't step away from your desk because global financial conditions are tightening from the surprise move from the BOJ. As we've been saying, Anna, yes, they are claiming, or Kuroda is saying that they are keeping policy easy, but if yields are moving higher, it makes it a more difficult environment for equities. European stocks off by 0.5%. They have clawed back some of the losses, but the losses continue when it comes to the currency space versus the yen. Anna, you were mentioning this, the fact that the yen is used so heavily as a funding currency. That means things like euro yen, Swissy yen, sterling yen, all of them declining at least 3% this morning. This is a broad repositioning that needs to happen also for those Japanese investors who are bringing money back home. So we're seeing bond yields, those are up in the 10-year yield about 8 basis points. Anna, it is hard to find an asset that is safe from the commotion caused by the BOJ this morning.
Yeah, absolutely. And let's focus in on the global market response. Maria Weitmaner joins us, State Street Global Markets senior multi-asset strategist. Maria, very good to have you with us. I want to start with the impact on stocks, which is not necessarily where we're seeing the biggest impact. We saw it in European stocks, as Danny was saying, and we did see it in US futures, paring that back a little. And I wonder if you think that that makes sense, because you know, the yen has been used as a global funding currency. The JGB yield curve control has been a policy then that has kept money cheap, maybe artificially, for global investors. Is this policy move then something that you would expect to put downward pressure on global stocks?
Yes, hello. I think, I mean, in general, we expect stocks to see a fairly challenging year going forward. So like little moves like that potentially kind of moving along. But I would probably say that the biggest impact for stocks going forward is maybe less of policy move, but more move towards kind of earnings-driven stories. So, I mean, when we're thinking about year ahead, is 2022 was a year of macro headwinds, and BOJ is one of those. And 2023, we expect a year of micro headwinds with corporate earnings really struggling. So I think it's more about earnings for the next year. But on a day like today, of course, kind of market responding, particularly being very, very liquid.
If it's going to be about the micro story, Maria, how do you position for that? In other words, if I'm an investor, for example, who likes to buy passively, who likes to buy at the index level, will I be hurt if I'm not picking individual names?
I still think there are, I mean, picking individual names would probably be preferred, and kind of really understanding which companies are far better to, are in a better position to maintain the profitability, protect the margin. So definitely active fund managers probably kind of a place to go. If you are passive investors, I think like more defensive styles probably would be good, like dividend yield, maybe large caps. So that type of strategies probably will do better than more riskier ones.
So if there is going to be this earnings story, you want to be careful. You want to pick individual names, perhaps go for the defensives. How much of that is already priced into this market? Because, Maria, it does feel like the warnings for this earnings season upcoming for 2023 are stacking up.
No, you're absolutely right. And to be honest, I'm really, really surprised. When I look at consensus earnings expectations, yes, you're right, they're coming down, but they're still positive. And particularly places like Europe, they're almost like double digit. That's really, really surprising. Like you say, we've been talking about recession, we've been talking about potentially more difficult times for corporates, but earnings expectations are still way too high.
Earnings expectations are too high. Are dividend expectations too high, Maria? Because I know that you like dividend payers, you're focused on dividend payers, but can you believe the estimates?
I mean, so dividends are, I mean, that's kind of a subset of markets. So that's usually more mature companies with better cash flow generation. So I think some parts of the market can potentially do better. And dividend companies we do like. So they're probably better protected.
And what about government debt markets then, Maria? As we sit here, we're digesting the BOJ's move, and clearly there's an impact on treasuries. How does this change the narrative for treasuries, for global bonds into 2023? Does it just add energy to the trends that are already in place, or does it cause you to pause?
I mean, we still probably would argue that Fed is the most influential central bank, and I mean, on the Fed, we'll probably argue that they're getting closer to the kind of policy targets, but there is still a big debate in terms of have they done enough to fight inflation, have they kind of slowed the economy down enough, and I think on that we are probably in a camp that there is more demand destruction that's needed. We still see very strong labor market, we still see enough consumer savings. We suspect, yes, they're coming closer to the peak rates, but I would be very surprised if we see cuts this year or next year.
Maria, if I can kind of make this conversation a full circle here, if there's some degree to which Japan, even if Kuroda isn't saying it, is starting to look at inflation in Japan, is starting to express concern. If we're having that story play out in Japan, are we really safe to say that essentially anywhere in this global economy in 2023 that we can start to talk about pivots? Can we talk about it again if even Japan there is concern about continued inflation?
Yeah, you're absolutely right. So we have we're very closely monitoring online prices, and it's interesting, like you mentioned. So Japan is seeing second largest monthly increase in online prices. I mean, only UK is seeing higher. So yeah, definitely inflationary problems are beginning to build up in Japan. They were already seeing some kind of longer-term inflation expectations going up in the U.S. They're quite strong in like U.S. and Europe already. So I mean, to our mind is that there is still more work that needs to be done. And I mean, good thing about Fed and ECB, they've been very on the ball, and they've particularly Fed, so they've been kind of addressing those policies. I mean, Japan, obviously, we know that they've been on the back foot, and we saw what it done to Japanese yen. But yeah, global economy, I think labor market, consumer savings, those are really two concerns that kind of continue to support those price formations.
Okay, Maria, thanks very much for your time. Maria Weitmaner of State Street Global Markets. Thank you very much, and thanks for joining us many times, of course, during 2022. We'll see you in 23. Coming up on the programme, the surprise from the BOJ. We will focus in on that once again. Derek Halpenny joins us, MUFG, Head of Research and Global Markets, EMEA and International Securities. We'll get his perspective, what this does to the yen, JGB markets and global assets. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with former U.S. Treasury Secretary Jack Lew. That's at 12 p.m. New York, 5 p.m. in London. This is Bloomberg.
The volatility of the financial and capital markets seems to have declined temporarily, but it has increased again recently. The distortion of the yield curve has become very strong, so we made some adjustments today. This is just to ensure that yield curve control functions steadily and does not mean a beginning of a rate hike, tightening monetary policy, or reviewing YCC.
Bank of Japan Governor Haruhiko Kuroda there downplaying the significance of the moves from the BOJ, but speaking after the BOJ certainly shocked markets by doubling a cap on the 10-year yield. The move helps pave the way for possible policy normalization under a new governor. Valerie Teitel joins us, Bloomberg Markets reporter, and can give us her take on this. Talk us through some of the broader impact then of the BOJ's move. Good morning, Valerie.
Good morning, Anna. I want to talk about what happened in front-end interest rates in Japan, and they're notably higher after this decision. And even though Kuroda said it again and again, this is not the start of a tightening cycle, that is clearly how the market is reading it. And why is that important? Because a lot of these front-end interest rates, the way these Japanese investors use these hedging instruments, it makes Japanese assets look a bit more attractive versus holding treasuries or holding bonds or holding gilts. And in my next chart, I can show you that, this tiny spike higher is probably just the first phase of a broader normalization in Japanese yields. And what could that cause? It could cause some real, true asset reallocation. We know that Japanese lifers are one of the biggest global holders of foreign assets. They hold 17% of treasuries. And look, we know that central banks have been stepping back in terms of their bond buying. The Fed is no longer buying treasuries. The ECB is no longer buying European government bonds either. If Japan starts to step back, who are these buyers of bonds going to be? And we know we're headed into a big year for issuance.
Yeah, Valerie, I love it. You have a chart up there that it does look like the Japanese yield is just so small compared to everything else. But I mean, if you looked at it on your own, it is massive. One of the biggest jumps since the 2000s. Valerie, thank you very much. Valerie Teitel. I mean, early 2000s. I guess we kind of still are in the 2000s. Anyway, here to help save me from myself is Derek Halpenny, Head of Research for Global Markets, EMEA, and International Securities at MUFG. Derek, what a day to join us on, which I'm sure you thought would be a quiet Christmas day.
Possibly, yes.
So that's out the window.
Yeah.
But I do wonder, is there more of this to come? Do you see this as an isolated move, which Governor Kuroda has really tried to emphasize, or is this the start of normalization?
He has really tried, and obviously given the price action that you've just covered in the markets, I think he's failed. And it was always going to be very, very difficult because, of course, the narrative has been building for some time, and it's impossible to get away from the prospects of change when Governor Kuroda is leaving. There's speculation that Prime Minister Kishida always has a desire to move away from Abenomics, and in particular, the onus of the BOJ in implementing Abenomics. And therefore, a reappraisal of the agreement between the government and the BOJ is still something that happens next year. And under a new governorship, a review of policy and then further policy changes. So this just obviously feeds that even more. And I think certainly the currency move, and again, showing the chart of these tiny moves on yen yields, when we know what's happened in broader markets this year, it's still relatively small. And the scale of the move in dollar yen, 3.5% to the downside, is just anticipating more to come next year.
How much weaker could we see the dollar versus the yen? It's at 132 now.
Well, I think obviously, as we all say, it's not going to go in a straight line. But when we plug in values that we think we could get to next year for treasuries in the US, assuming a cut by the end of next year, the 10-year JGB at 50 basis points, positive 2-year on JGB, and a couple of other variables that don't change very much, you still get dollar yen going to about 125. So I think that's ultimately where we're going to get to before we get some equilibrium. But we do see the dollar coming back a little bit in Q1. So, 3.5% to the downside today is pretty chunky based on what's happened in rates. But I think ultimately that's where we're going to go.
So 125 on dollar yen. I wonder if this reminds us, Derek, of the way that the BOJ does have a habit of surprising. Those with long memories have been pointing out that there was a surprise actually on Christmas Day back in 1989 from the BOJ. What do you make of the timing of this? The fact that Governor Kuroda is doing this when markets are probably pretty thin, when many people are distracted by holiday preparations?
Yeah, I think timing-wise, now we had argued it wouldn't happen today, although I did argue to our clients that we were in a scenario, including the fundamentals in Japan, which we could possibly touch on, but in terms of the market scenario, now was a logical enough time to consider it, purely because global inflation looks to have peaked. We've had two compellingly weaker than expected CPI reports in the US, and 10-year US Treasury yields are down 60-odd basis points from the highs. So if you want to raise the band in which you can trade without having to immediately fight the top end of that band, there is a logic to the timing. And I think that's one of the reasons why the action was taken today.
Okay. And in terms of this being the start of something, you were setting out the narrative that this just feeds, Derek. A lot of people were saying if you're going to abandon yield curve control, this was in weeks and months gone, people said if you're going to abandon yield curve control, there's no way to half do that. You've got to follow this policy or not. Have we seen Kuroda try to find some kind of middle ground here?
Well, I think he has essentially by announcing the other measures today as well, which is, of course, a ramp up in JGB purchases, including unlimited auctions going forward and scheduled competitive auctions as well. And importantly, across the entire curve. A lot of the buying this year was in the 10-year sector alone, but of course, they nearly own all of the 10-year sector. So they've had to broaden it out, and what they hope to achieve is a more normalized curve to bring back some more normal market functioning. But having that increased purchases of JGBs, I guess the BOJ is hoping it diminishes the appetite for a very quick test of the upper end of the range.
There does feel some irony to making these moves for the sake of financial stability, but then because of those moves, having to buy more bonds to make sure there's financial stability.
I guess. I'm assuming perhaps he's hoping the communication of being able to do it means they won't have to, which, of course, on many occasions, the unlimited purchases that are there at the moment, they haven't been using them. So.
Right. Well, quickly, Derek, I do want to get this in because one of the things Kuroda talked about was this idea of China actually being something which would act as a disinflationary force because of more COVID among the population, of more supply chain issues. Do you think that's the right way to look at it, or is it an inflationary force once the reopening happens and there's more demand from that?
I think, clearly when you look at measures of global supply chain constraints, we've seen a dramatic improvement. And now, goods inflation everywhere is falling, and particularly we see it quite clearly in the US. So I think from that perspective, if we move to a reopening, to me it's demand, it's a change in demand conditions and ultimately could feed into inflation. If we have further problems over the short term, obviously that could lead to some, deterioration in those supply constraint problems again. So I guess it matters in terms of the extent of the problems that emerge in China.
Yeah, and on that subject, we've seen VW, just a story dropping this hour, saying that VW has been forced to rethink its production in China as workers fall sick. So that's the sort of short-term twist on this. Derek, thank you so much for joining us. Derek Halpenny of MUFG helping us to understand the short and the long-term implications of what we've heard from the BOJ. Coming up in the next hour, Win Thin joins the team, Global Head of Currency Strategy at Brown Brothers Harriman. Will get thoughts there on the yen. That's at 6 a.m. in New York, 11 a.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Anna Edwards in New York. Now let's take a look at some of the things that are on the schedule today. In the UK, Chancellor Jeremy Hunt speaks in the House of Commons. That'll happen at 6:30 a.m. Eastern. U.S. data due also includes permits and housing starts at 8:30 a.m. Euro area consumer confidence data, that will be out at 10 a.m. And UK Prime Minister Rishi Sunak appears before Parliament's liaison committee. And then later today, we will get Nike earnings shortly after 4 p.m. And Anna, I know I should be caring most about all those UK things, but I gotta say, I think Nike will be fascinating, given it will give us a glimpse into how big of markdowns that they'll have had to take this holiday season and how things are shaping up in China, whether there is demand there and how COVID, the resurgence of which after reopening is impacting them.
Absolutely. A lot to be said about China, the way that this impacts the demand story globally, but also, as you referenced earlier in our conversation with Derek Halpenny, supply chain disruption and what that does to global inflation. Thinking about that takes us nicely back to the BOJ, where we started this programme, something we've spent a lot of this hour talking about, Danny. We talked to Derek Halpenny there. 125 is where he sees the yen could weaken too as a result of this policy.
That's the thing, Anna. This is a market that is very willing to push the BOJ, that is very willing to speculate that this is not the end of it. Even though Kuroda has said over and over again, this is not us easing. However, his term ends in April. It does seem like this market expects there to be more steps to abandoning yield curve control.
Yeah, absolutely. Sorry, and I should have said strengthen to 125, of course. And interesting to think how they cast this this policy change from the BOJ, saying this isn't hiking, as you suggest, saying that this is all about sustainability of the yield curve control. As we heard, though, from Derek Halpenny, the market sees it very differently, sees this perhaps as the beginning of the end. This is Bloomberg.